You probably do it every day, swiping open an app on your phone, checking a number on a screen. That green number provides a deep, almost invisible sense of psychological safety. We instinctively treat that app like a digital safe. We imagine thick stacks of paper bills sitting inside a vault somewhere, completely loyal to us, just waiting for our command. Then, without warning, a card gets declined at the grocery store. You try to transfer funds and an error message pops up. Your account is frozen. The money still exists, but you are entirely locked out of the resources you need to survive. Think of it like renting a gym locker. You put your belongings inside and carry the key, but the facility manager holds a master key. Under specific conditions, they can lock your door from the outside. You can look through the glass, you can see every single item you own, but you cannot reach any of it. A frozen account is not a software glitch. It exposes a truth most of us instinctively resist. The money in your bank account is not legally yours in the way a physical wallet in your pocket is. When you deposit a paycheck, you aren't storing property. From a strict legal standpoint, you are making a loan to the institution. The bank immediately becomes the owner of those funds. You become what is called an unsecured creditor. You hold a legal right to demand the value back, but you possess zero ownership of the actual physical cash. Because the bank technically holds your claim rather than your property, they maintain immense latitude over it. They can pause or restrict your access if internal rules, external investigations, or legal orders require them to do so. You see this dynamic most clearly when a bank fails. Depositors don't go to the vault to retrieve their personal property, they wait in a bankruptcy queue. Deposit insurance systems, like the FDIC, exist specifically to protect your legal claim as a creditor, not to guard physical bills. The moment value enters the banking system, it stops being physical property. It becomes a ledger entry, a conditional promise. This shows typical spending. We imagine detectives reviewing records when accounts freeze, but modern restrictions are triggered by behavioral AI. If you receive a large transfer or buy coffee in a new city, the machine flags the anomaly and restricts access. Sometimes these deviations trigger a suspicious activity report, or SAR. Even entirely legal actions, like consistently depositing cash just under the $10,000 reporting threshold, will trigger these internal federal alarms. And the institution cannot warn you. Under federal law, banks operate under strict gag orders. They are legally forbidden from disclosing that a SAR has been filed or that your account is under investigation. This automated net routinely catches freelance workers, nonprofits, and small business owners. The software is indifferent to context or character. It only sees mathematical patterns. You don't have to break a law to lose access to your livelihood. You only need to behave in a way a computer finds unusual. Above the bank's internal algorithms sits the state. Federal tax authorities and courts hold the power to completely bypass a bank's terms of service, ordering levies and freezing accounts directly. Under the legal doctrine of civil forfeiture, law enforcement agencies can freeze and seize assets based entirely on suspicion. The burden of proof flips completely. The owner is forced to prove their funds are legitimate to get them back. In extreme economic crises, this state power scales up instantly. Governments have frozen entire national banking networks, deploying capital controls that limit citizens to withdrawing a few dollars a day. Individual risk transforms into a collective lockdown. The deepest threat in these situations is the timeline. Bureaucratic investigations move at a deliberate pace, often taking weeks or months. Human survival requires daily cash flow. This mismatch creates a cascade effect. It operates like a dam appearing overnight on a flowing river. Upstream, the money accumulates. Downstream, automatic rent payments bounce, credit scores drop, and business supply chains fracture within days. A freeze is rarely a temporary pause on a balance. It is a rapid interruption that can dismantle the systemic continuity of a person's life. The global architecture of financial surveillance is currently evolving past the traditional banking model. Dozens of governments are actively developing central bank digital currencies, or CBDCs. This introduces programmable money, digital cash that has restriction capabilities built straight into its core code. This flowchart illustrates the shift. Programmable money completely bypasses the private bank intermediary. It allows the issuing authority to exercise freeze capabilities directly at the currency layer, shutting off a user's spending power at the source. It highlights a deep paradox. The more frictionless and convenient digital money becomes for the user, the more perfectly it can be controlled at a distance by institutions. Abstract, ledger-based wealth is an immense leap forward in civilizational efficiency, but its hidden price is that your wealth is now instantly controllable by people you will never meet. If an algorithm flags you, or an agency issues an order, hiring a lawyer is the final step. By the time the legal process clears your name, the cascade effect has done its damage. The most effective defense against systemic restriction is optionality. Holding accounts across multiple institutions, diversifying asset classes, and maintaining physical, off-network forms of value provides immediate protection when a primary access point fails. Modern financial literacy needs a broader definition. Knowing how to grow wealth is useful, but understanding financial vulnerability, knowing how access to your money can be severed, is essential for actual independence. Look closely at that clean, seamless banking interface on your phone. Sitting directly behind the screen is a massive, invisible architecture of surveillance, compliance, and institutional power. Our modern financial system operates entirely on conditional trust. Your digital money is completely yours, right up until the exact microsecond that the system decides it isn't.